Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's September 26th. It's the last week of September. Thank God it's the last week of September. September tends to be one of the most bearish and negative months for the year, where the market tends to drop between 4 and 5%. And we are seeing that. So things tend to pick up a lot more in October. And based on what I'm seeing, and I'll get into all of this in a few minutes, things are actually looking a lot better than most people think, most traders believe, and I'll explain to you why. So we're opening up, the Dow's down about 100 points. Most of the action we've been seeing last few days, the down action we've been opening on has been due to global markets, which we'll get into in a bit. But we are really oversold right now in the short and medium term. Now, as far as the week is concerned, we've got a couple of things on the agenda that we need to be prepared for. Today's going to be a kind of a loose day. We've got some Fed speakers talking. You may want to keep your eye on the bond market, which looks like it's bottoming out, by the way. And the bond's losing way too much value in comparison to the stock market, too. Now, tomorrow, you've got consumer confidence happening. You've got durable good orders happening. And here are the expectations. So you could see what the median forecasts are, and you could see what the previous number is. As the week continues, you've got pending home sales. You've got trades and goods, and the advance report is coming out. Thursday, we've got the jobless and continuing claims. And on Friday, we've got the core PCE index and the PC index and consumer spending, which will be very interesting. And throughout the week, you've got the Fed talking. Now, here's what I want to show you, and this is really important. This is the put-to-call ratio. I couldn't make this up if I tried. Now, anytime we're above this green line right here, we're oversold, excuse me. It's inverse. Higher here means lower in the stock market. Lower means higher in the stock market. So whenever we go below this line here, this pink line, that means we're overbought, too much too fast. Whenever we're above this green line, it means there's too much selling pressure. Now, I want you to see something interesting. This is the last 9 months, okay? Highest level in the last 9 months. This is the last year. Highest level in the last year. Watch this. Highest level in 2 years. Watch this. Highest level in 3 years. Watch this. Highest level since 2018. So this is really high. As you could see here, we haven't been up here since these two times. And these are the last 2 times in recent history that we spiked like that. And afterwards, we came off pretty well. So as you could see here, on a 10-year basis, we are at the highest momentum levels, folks. We've been since 2013. And on a 20-year basis, we are in the highest momentum levels we have ever seen here. This is really important. This is the sentiment. This is put buyers compared to call buyers. And when we get here, I mean, forget here, when we get anywhere above this line here, that means we're really oversold. But this is the highest level I've seen on record. And on a weekly level, it's the highest level. Even on a weekly, like that's daily, let's see, weekly level. Weekly level, it's the highest level I've seen either ways. I think this is the highest level I've ever seen. That's what I'm trying to tell you. It's up 17%. And this is telling me that rubber band isn't just stretched out. That means that rubber band is so stretched out, that means it's just ready to move or it's going to break. And rubber bands don't break because markets don't break, fortunately. And we're not in a position for it to see it break. But this is a big turnaround. Also, volatility, hesitantly, it has now been coming up to the previous levels or near the previous levels. We're not that high up. But the momentum levels are just telling me this is just crazy. Highest momentum levels, highest put-to-call ratio I've ever seen in my life, 136. I honestly, I don't remember ever it being that high. With that said, if you look at momentum levels on the NASDAQ, and this is the NASDAQ 100, this is the number of stocks trading above the 200-day moving average. The momentum level is now, this is 2008, okay? Look at this. I mean, this is historic times we're talking about. I mean, if there was a time to buy stocks, folks, this is it. I mean, look at this. Look at the 50-day line. Yes, and look at the stocks. Consumer staples, only 24 stocks above 200-day moving average. Utilities, 38%. It's energy, 24%. Look at the 50-day. Zero. This is momentum, folks. When you're talking about momentum, just to give you a perspective, let's look at the 50-day. This is the S&P 500. Look at where we're at right now. This is almost where we were the first time this year when we bottomed out. We're there again. And again, this is 2020 levels, COVID levels. Let's go 5 years. We're below. Here, hold on a second. This is 2008, right? This is COVID. Look at where we're at right now. I mean, it's crazy. Let's look at the NASDAQ 50-day. This is really worth doing because this is historically significant. 3% of stocks are trading above the 50-day moving average on NASDAQ. Look at that. Look at that. And look at we are lower on the momentum level on the NASDAQ than we were in 2008. So in terms of put to call ratio, let's see 2008. Let's see, do we have it? Yeah. We are higher than 2008 on the put to call ratio, which means there's more buyers of puts than calls. And the NASDAQ 100 on a 50-day line is also below the 2008 level. So to give you some idea of the raw momentum levels, we are so overdone right now. It's just sick. It's just sick. Like, this is a time to start buying. And if you look, and again, it doesn't mean long term. It means short term. This thing needs to bounce. I mean, it needs to bounce hard, really, really hard. We're below the 200-day moving average. And if I had to put $1 on it, I would say we are going to bounce really, really, really hard. Let's talk about global markets. Most of the downside last week, by the way, and this is really important, in the stock market actually happened because of global economy and bonds, not because of U.S. stocks itself. And also, let me just kind of jump back before I get into this. I want to show you something else. I should have showed you this earlier. Even though momentum levels are low, look at the Russell 2000. 9%, 4% on the S&P, 14%, 17%. The fact that the Russell is outperforming both the NASDAQ, 17, 10, 9, 3, both is a very, very positive sign. It's also telling us that small caps are starting to sniff the end of this bear run and are starting to look forward to a bull market. Very, very important. And also, again, it's really important to know that most of the downside in stocks this week is caused by Europe. For example, the downside we're seeing right now in the stock market, this down 160 points, that's in the Dow, which isn't all that significant. That's mostly caused by the British pound declining to all-time lows against the U.S. dollar on concerns over planned tax cuts in Britain. So the weakening currency piles pressure on UK's new Conservative government, which has gambled that slashing taxes and increasing borrowing to compensate will spur economic growth. I don't think they got their head on straight. Many economists say, including me, and I'm not an economist, but it's more likely to fuel already high inflation, drive down the pound, and drive up the cost of U.S. government borrowing. A potential perfect storm for a nasty, nasty tailwind. So I don't know what they're thinking. Slashing taxes, increasing borrowing to compensate. Like, what are you people doing? You're averaging down. Now, the recent moves by the U.S. Federal Reserve and other central banks to raise rates are designed to curb decades-high inflation, but they are also raising the risk of a recession. Last week, the Fed lifted its benchmark rate, which affects many consumer and business loans, to a range of 3 to 3.25. It was near zero at the start of the year. Now, the Fed also released a forecast suggesting its benchmark could be 4.4% by the end of the year, a full point higher than envisioned in June, which would be really, really amazing. Now, the recent rise in the U.S. dollar against the other currencies is a major concern for many countries because it dents profits for U.S. companies with overseas businesses and puts financial squeezes on much of the developing world. So when the dollar approached the 146 yen last week, the Japanese government and Bank of Japan intervened. And the dollar has been trading at about 143 yen since then. The yen is really, really selling off. Now, as far as sectors are concerned, you've got utilities, you've got healthcare, you've got consumer staples, and energy. They are still leading, and I'm expecting them to continue leading for the foreseeable future. You got to stay defensive right now. This is not a time to go into consumer discretionary, although a lot of traders are starting to look at consumer discretionary because it looks like it's holding on better, and it's at the 200-day moving average on a weekly basis, which is a very, very strong sign that it's going to bounce. The bottom line is everything looks very, very, very bouncy right now. And overall, I believe the market is going to set itself up for a nice move up to the upside. If you look at the bond market right now, you will see that the bond market is grossly oversold, and it's diverging. Now, this divergence right here is typically telling us it's way too much too fast, so I'm expecting the bond market to come into its base. In a nutshell, expect lower volatility, expect better trading range, but with that said, you still have to be defensive, which means you got to be looking at the top stocks. Albemarle, healthcare, General Mills, Genuine Car Parts. I don't know about Twitter. Signal's looking good. Humana, Lilly, Dollar General. Stocks, you want to focus on stocks that do things people need, not want right now. Like we need car parts for cars. We need cars, right? We need chemicals. Albemarle. We need basic materials like General Mills. So again, these companies, Kellogg's, no one's going to stop shopping at Dollar General because there's a recession or inflation. No one's going to stop going to get their drugs at their doctor. Cardinal Health, the number one healthcare provider in the world or in America. So the point is, you want to be defensive. You don't want to be speculative. And you want to stay strong. And I'll make another recommendation. While we're in this mess, try to stay long the indices instead of individual stocks. I think if you're long the indices, you'll get a better bang for the buck, and you'll see a pullback a lot faster than you would individual stocks because we're really overdone right now. So before I let you go, I am expecting more upside, not downside, as the week continues. And folks, believe it or not, when things look the worst, that's when you get the best opportunities. As far as I'm concerned, this put the call ratio highest in history. Momentum levels in the S&P index, 50-day line, below levels that we haven't seen since 2008. I mean, it's maddening. It's maddening. But that's the best opportunities. Those are the best opportunities. I mean, look at this. We are overdone right now, like really, really overdone. So there's a lot of opportunities in the market. I'm becoming aggressively bullish at these levels, and I think we're going to be going up for quite some time, at least for the next couple of weeks, maybe 3 weeks, and I think it's going to start this week. Now, if you haven't heard yet, I finally cracked the code on a brand new trading strategy that searches for patterns on 146 little-known explosive stocks. One of the patterns, the shooting star, even had a backtest win rate of 100% over the past 5 years. Now, once the shooting star pattern appears on a daily close, all you've got to do is enter the position the next morning. It's that simple. And then exit when the daily close takes out the previous day's high. It's that simple. Forget what the S&P is doing. Really, forget what it's doing. And check out my code breaker stocks. Each trade alert will even give you a backtest, historic win rate, and other vital stats before you enter the trade, so you could see how that setup performed on that stock historically. Nobody's doing it except us. Follow the link below, check it out, do it now, learn everything you can about Codebreaker. The spots are really going off the shelf. I think we launched like 356 spots. I think we have less than a third left. And when we sell out, prices are going up. You got to check out the video. Get a pen, get a paper, take notes. There's so much value there I can't even begin to say. I give you my completing screening process to find these high alpha code breaker stocks. You really don't want to miss out. And post some comments for me. I want to see some comments below the YouTube channel. Bye, guys. Take care. Have a great, great week ahead.